Hello, welcome to another live webinar with us from Phillip Nova. And who do we have in the studio is none other than Edward Pye. He's joining us from UOB Asset Management, and we're going to be talking you through about the opportunities in China, step through to the future of China. And for those of you who are joining us for the first time, well, let me tell you a little bit more about what we're going to cover today. As we know, the second largest economy in the world, that's China, is transitioning from a high-speed economy to the one of high-quality growth. This transition has transformed China, leading it to begin a new age as a leader in innovation with a society that has prospered at an unparalleled pace in its high-speed rise. Join us in this event as we cover how today's macro environment is creating irreversible structural opportunities for China and how the ChiNext Index provides exposure to these domestic opportunities within China and with the potential of offshore exportation. All right, so what will we cover today? Introduction to Chinese onshore equities, the ChiNext Market and Index, long-term structural opportunities in China, and how ChiNext Index provides these opportunities to the investor. Edward Pye, if you are here for the first time, is part of our UOBAM's intermediary sales team, and he is responsible for the external distribution relationships with the intermediaries in Singapore. Edward has a demonstrated history of career in both the banking and fintech industry, starting his retail banking career in 2013 and later on pivoting his career towards technology-driven financial services. Before we begin, can I just do a quick check if you can hear us? If you can hear me loud and clear, let me just do a quick poll.
Yes, we can. I can.
All right, great. Thank you, Edward.
Yeah,
And if you're all set to go, you have the mic right now.
that's great. I hope you can see me as a speaker as well as also see my screen that I'm actually sharing. So I think without further ado, maybe we can actually just start the webinar. So thank you, Sri, for the great introduction, about what I'm going to talk about today, who I am as well. So yes, my name is Edward, for those who have not actually heard my name. I'm from the UOBAM Intermediary Sales Team. So today we will be talking about our UOBAM Ping An ChiNext ETF. Really appreciate the opportunity that Phillip Nova is actually, allowing us to present to the your investors out there. It's really a great opportunity. So we actually launched this ChiNext ETF in 14 November 2022. So maybe what I can do is that I can share with you, what are the opportunity, what are the value proposition that ChiNext, ETF brings about to the investors out there, especially to the local investors in Singapore as well. And of course, UOBAM being an asset management house, what we are doing is that today, we have different investment solutions, be it in mutual funds or ETF. We have all the solutions for our investors, both for retail and institutional. And I believe on the Phillip Nova platform, there's offerings of ETF as well listed on SGX. So I think this is a great opportunity to actually share, to all the investors out there today, how ChiNext can actually help you diversify your portfolio, if not even complement your portfolio, and capture the great opportunity that is presenting in the growing in China as well. So with that, let's just look into the step through to the future of China itself. This is the agenda for the webinar today. So what I will do is I'll probably go through the introduction of the ChiNext market, what is the ChiNext Index, why invest, some of the notable companies in the ETF itself, and why our ETF. So I think that is the whole structural of the webinar itself. So I think one thing is many of us actually, are very familiar with the Chinese, all the H shares, your Hang Seng and all this kind of thing. But in terms of the Chinese onshore stock market structure, I think, it's always good to just kind of emphasize and talk about it as well. So in the next slide, just give me a moment. Okay, so I think, yeah, so let's just talk about the structure, how the onshore is, how the Chinese onshore market is. So Chinese equities are actually available in both onshore and of course offshore markets, and there are several share classes to choose from. So while there are some restriction on the type of security investors can pick, I think what we are seeing today is the Chinese authorities are continually making improvements to the market structure, increasing access and liquidity. So today when you look at Chinese mainland listing, they are either on the Shanghai Stock Exchange or the Shenzhen Stock Exchange, and we have the later edition, which is the Beijing Stock Exchange. But for both the Shanghai Stock Exchange and the Shenzhen Stock Exchange, they were actually launched in 1990 as a way of modernizing and expanding the economy. So for the Shanghai Stock Exchange, is actually located in China's financial capital, financial capital, and it actually tend to be larger, more industrial, and often, formerly state-run companies. And the largest group of investors out there are mostly institutionals. But for the Shenzhen Stock Exchange, it's actually based in one of the modern cities in China, tend to include smaller emerging sector companies. The bulk of investors are mainly both a fair share of institutionals as well as individuals as well, and both exchanges have scale. So the Shanghai Stock Exchange is the fourth largest exchange in the world by market cap, and Shenzhen Stock Exchange is basically 8. So if you look into this structure itself, both Shanghai and Shenzhen operate a multi-board system designed to group companies by similar features and apply different listing rules to facilitate, of course, better capital allocation by investors as well. So Shanghai, when you look at Shanghai, it actually runs the main board of the Shanghai Stock Exchange main board, which has a requirement around government approval and pricing. And you have the more growth oriented, which is the Science and Tech Innovation Board, where we call Star Board basically. And the other one is Shenzhen, which operates a main board as well. You have the Shenzhen Stock Exchange main board, and ChiNext Market, which is also the other board, which is established in 2009. So ChiNext is open to companies of all sizes that meet the listing criteria, but it focuses mainly on innovative growth companies and startup, particularly in technology management and business model, and in both traditional and the new economy as well. So when we look at this into the the ChiNext market itself, like I've mentioned, to attract innovative and fast-growing enterprises, it has less stringent listing criteria, and of course, it itself is actually inaugurated in Shenzhen in 23rd October 2019. When it was inaugurated, they only have 28 firms with a market cap of I think 11 billion trillion in dollars. But currently today, if you look at it, there are about 1,200 companies listed with a total market cap of nearly 11 trillion renminbi in market cap. So I think you can see that within the years, it has tremendous growth in terms of the number of company listed as well as the market growth as well. So that is basically what ChiNext market is all about. So moving on to ChiNext market, what we want to talk about is basically the ChiNext Index. Let's focus on what ChiNext Index is all about. So ChiNext Index is basically the the benchmark and the flagship index of the ChiNext market itself. It comprises of 100 largest and the most liquid A share listed on the Chinese market. So you have 1,000 stocks in the investment universe, which is basically a ChiNext market, and they actually choose the largest 100 and most liquid listed share on the ChiNext market. And it has diversification benefit, because one thing is that you have the top 100 companies in size and liquidity, and then also in terms of the growth opportunity, actually provide exposures to China market leaders in their respective industries like the CATL, East Money, and Minray, which I will actually come and mention in the later part of the webinar. And when you look at the index itself, it's actually rebalanced on the semi-annual basis. So it's rebalanced twice a year on the 2nd February every June and December as well. So let's talk a little bit about the index, ChiNext Index methodology. So it's rather straightforward. So when selecting, constituent stocks for the ChiNext Index, the index provider basically calculates the daily average total market cap and the daily average trading value during the previous 6 months of all the stocks in the stocks universe. Thereafter, they rank the stocks in the stocks universe in descending order according to the daily average trading value and excludes the bottom 10%. And thereafter, lastly, they rank the remaining stock in descending order according to the daily average total market cap and select those which rank in the top 100 as the constituent stocks of the ChiNext Index as well. And that's how your top 100 stocks actually come about in the index. So when we look into the sector allocation in the index itself, you can see that it's actually fairly diversified. You have the top threes are basically your industrial, you have your healthcare, you have your information tech, and you also have things like consumer staple, financials, materials. So you can see that it's quite broadly diversified in nature in terms of the sector allocation. So some of the company included inside this index is basically things like your advanced industrial, where your iron lithium battery manufacturers for EV, renewable energy equipment manufacturer. You have your healthcare technology. In terms of consumer staples, you have like agri commodities and also even food products processors as well. Yeah. And one thing about the ChiNext Index itself, when we look at in terms of liquidity, it has high liquidity. So what this chart is basically showing you is in terms of the index daily trade value, we compile the data and compare against the CSI 300 index, which is basically your largest 300 China A shares from both Shenzhen Stock Exchange and Shanghai Stock Exchange. You have your S&P 500 index, Hang Seng Index, and ChiNext Index. So basically, in terms of the daily trade value, right, the CSI 300 actually holds the large share of the daily trade value. If you look at it, it's actually highlighted in pink. It takes about 70 to basically around nearly 80% of the trade value, and the S&P 500 actually only takes about 20% of it, and Hang Seng is about 15 to at most 20% only. So when we look at it, right, ChiNext is basically about 25% of the CSI 300 index. So that's almost equivalent to your well-known index like your Hang Seng Index in terms of liquidity. So you can, it just shows that it is highly liquid. There are people actually looking into this index and basically trading as well. And of course, what we have also seen is that in terms of in terms of the different China Tech Index comparison, we have seen ChiNext Index, we have seen Star 50 Index, we have seen Hang Seng Index. I think maybe I can actually just share the differences between a few of these. So the thing is that both Hang Seng Tech and Star 50 indexes are relatively new, right? They were only launched recently in July 2020. I think, however, ChiNext Index start trading in 2009, so which has a much longer track record as well. And the thing is that the difference is that the universe that these indices actually represents are also of a major difference. So ChiNext Index is of course, the flagship index of the ChiNext market of the Shenzhen Stock Exchange. For the Star 50 is basically the index for the Shanghai Stock Exchange Star Market, and Hang Seng Tech Index represent the 30 largest technology companies listed in the Hong Kong Stock Exchange. So, there are also differences to the dominant sector that each index covers. So ChiNext Index focus would be on a growth, innovative companies with diversification across industrial, healthcare, information tech, consumer staples, financial, I've shown you as well, and the Star 50 mainly they actually concentrate on more advanced tech, semiconductors, biomedicine, and also on the advanced equipment industry. Whereas Hang Seng Tech emphasis is mainly on the dominant sector that will be around, internet businesses, the like of your fintech, cloud technology, e-commerce, IT, and consumer discretionary. So, and when we look at some of the things, ChiNext basically has a slightly stricter listing requirement than Star, but it also accommodate a wide range of a company. So ChiNext basically has no sector restriction, while Star focuses mainly on technology and science. And the distinction between ChiNext and Star may be somewhat ambiguous, but that is not necessarily a bad thing, as competition between them may actually provide investors and company with a better service. Because what we have seen in the market is a lot of comparison between the ChiNext index as well as the Star 50 index. That's why I think this is a good way to kind of show the differences between each of the China tech index comparison. So basically, I've actually mentioned how the overall Chinese onshore equity structure look like, what is ChiNext Market and what is ChiNext Index, and of course also did some comparison on the different tech indices. So with that, what we can do is we can actually look into today why invest into ChiNext Index. So if you look at it, that's how I will actually go through each one by one. China's macro, after that followed by the structural opportunity, as well as lastly on the investment fundamentals. So when we let's look into the China macro. So we have seen a lot of new headline on the external macro environment impact, especially on the China, the US tech war. You have seen things like the US Chip Act, you have seen the US Chip 4 alliances. So basically, let me just go through what are the different on the China, what are the some of the features of the US Chips Act as well as the Chip 4 alliance. So the US Chip Act basically provide US about 50 billion in manufacturing grant and research investments, and investment tax credit in the semiconductor field. So what US President Joe Biden actually did was he actually added his signature to the CHIPS Act 2022. So in order to officially enact legislation on the emerging technology, especially on the semiconductor. Now, as mentioned, the Act actually provides 50 billion in manufacturing grants, basically, right? So apart from focusing on building the United States semiconductor manufacturing capability, the legislation make a note of the US cooperating with like-minded allies to build a robust semiconductor supply chain. And this has, of course, set off talks to of another technology alliance in the semiconductor value chain, and that seeks to eliminate, of course, what they deem as bottlenecks and build self-sufficiency. And even technologically advanced states such as the US and Japan realize the futility of seeking self-sufficient in the semiconductor space. Now, in this case itself, what happens is that there has been a pivot towards bringing together techno-democracies in hope to covering all bases in the complex semiconductor supply chain. And one such alliance that we have seen that have kind of speculated form is that the Chip 4 alliance, which basically comprises of the US, the Taiwan, the South Korea, and the Japan, which was a partnership proposed by Washington in March. So basically, what these two do is the Act and the alliance does is to actually bring semiconductors manufacturing back to the US shores, and also trying to exclude the Chinese mainland from the global supply chain. So this has been a very harsh, what we call harsh kind of policy, implementation that's done by the US to actually kind of restrict the Chinese in terms of advancing their leading technology progress, and that is how actually it limits the progress in terms of the 5G, the 6G telecommunication, in your EV, renewable, your AI, and of course with China trying to be one of the next innovative powerhouse in the world, advanced chips are vital to the success of this future technology. So in the face of such US curtailment, I think it's very important for China to be self-reliant at every level of the semiconductor supply chain, and it is definitely a very complex process for China to actually advance in their future technology, with this being in place as well. So this is one of the what we call the very obvious external macro environment impact that we're seeing in the today's US and China tech war. Another one is also probably in the China's domestic challenge. One thing is that in terms of the demographic, they have a demographic challenge as well. China is getting broadly old before getting broadly rich. Now that's a very dark and demographic cloud on the social economic horizon. So in 20 years, China's elderly will double to 10 to over 20% of the population, and by 2050, right, 330 million Chinese will be over 65, and China's dependency ratio for the retired will actually exceed 40%. That means to say, there'll be roughly 2 working adults bearing the full burden of supporting 1 senior citizen, and a typical young working couple will have to support actually 4 elderly parents, which puts unprecedented pressure on the family bonds, and adding the number of children below 15, the dependency ratio could actually reach about 70%, and there's insufficient wealth to create a national safety net. So I think these are some of the demographic challenges we see. So in China itself, it is an aging population. We are also seeing some of the social policy challenges in terms of education, health, social safety net. We have seen middle income trap. And another thing is also on the environmental issue front. About China, unfortunately today is still being deemed as the world, largest polluter in terms of the CO2 emission as well. So these are some of the domestic challenges that we are seeing in China today. And the thing is, of course, with that along, some of the things that we probably have to also kind of highlight is that in terms of the monetary policy itself, we have talked about both external macro environment impact, we have talked about the local or the domestic challenges, and another thing is also the monetary policy. Now, why am I bringing out monetary policy today? If you look at all the headlines, another famous headlines this year we see is basically on inflation number, the monetary policies from the developed countries, central banks. And if we look at it, these are the headlines that are actually capturing our attention. We are seeing a high sticky inflation. We are seeing central banks around the world basically increasing their interest rate. But in terms of China, is very different. If you look at it, China is the only one of the few central banks around the world that is actually cutting rates, which is actually a group for the growth company. But if you look at all the other, like your Fed, your Bank of England, your ECB, they are actually on the rate hike trend, right? And the thing is that basically why? Because in terms of one thing is that and we look at the inflation number, right? China's consumer price index actually hit a 2-year high in July with just a 2.7% increase year on year. But when we look at things like US, they are looking at about 7-8% in terms of the inflation. So you can see that China's inflation numbers are there, but it's not as high as the other developed nations as well. And then that also gives them some of the monetary policy leg room to actually maneuver in, where they actually are able to actually cut and provide growth for the economy. But with that, despite being said, I think one thing is that when we look at some of the economic data, I think there has been a broad-based growth slowdown. So after a stronger than expected recovery in the third quarter of 2022, I think China's economy is still struggling to accelerate its growth, right? Several key economic indicators such as your industrial output, retail sales, your FAI, or what we call the China Fixed Asset Investments, released by their National Bureau of Statistics in November itself, shows a slowdown in growth. That is expected because the domestic economy is under the strain from several factors, including continuing COVID-19 limitations. You have a weakening property market, you have a sluggish global economy and rising inflation rates in the foreign markets that I've actually mentioned. But despite that, what we see is that certain sectors still saw significant month-on-month growth, despite the overall slowdown. In particular, especially the green energy and the smart products such as new energy vehicles and solar energy batteries. So what we see is that in terms of the new energy vehicles, it was actually up nearly about 85% year on year. Lithium batteries grew about nearly over 140% year on year, up from about nearly 11% in September. I think meanwhile, growth of the value-added output of the higher manufacturing industries also outpaced the overall industry sector, reaching nearly about 11%, growing about 1 percentage points faster than in September itself. So basically, what is fixed asset investment? Fixed asset investment is actually one of the main measures of the capital spending in China itself. So it refers to investments in construction projects, with a total planned investment of more than 5 million yuan. So the growth of FAI in October actually increased about over nearly about 0.1% 6% month on month, and of course the slowdown is from about 6% in the first half of 2022 to about nearly 6% in the period from January to September 2022. So I think there are certain areas that we see a growth as well as opportunities, but overall we do acknowledge that the overall growth of China has actually kind of slowed down, and that is expected. If you look at a lot of the analysts, a lot of the economists out there, it has been saying that China will in the future will be growing to about 3 to 5% on an annual basis. That's needless to say, because Chinese or the China economy is in a growth transition. It's no longer that kind of high speed, high growth, low low value chain kind of manufacturing. Is not today. China is actually different in terms of the economic dynamics as well. And of course, the next thing that we probably will want to actually kind of talk through is what we have seen is China's under Xi's third term, right? That's what we have seen in the MPC. So I think one thing is that this is actually not necessarily a bad thing under in terms of Xi, having that, securing that third term with his people in it. I think with this along, it's easier for President Xi to actually push for the great rejuvenation of the Chinese nation. So I think he has actually mentioned in one of his speech, which is called the 中华民族 伟大的复兴. So I think this is something that is very much emphasis in his policies in terms of moving China in the future as well. So basically, the rejuvenation of the Chinese nation come with in the background of scientific and technological revolution and industrial transformation, and we are seeing it in today's China as well. Now, I think another thing that we have also seen throughout this year is in terms of the US, China, and Taiwan kind of hustle and tussle, the tension rising. I think the reunification of Taiwan is still an ultimate goal for China itself, but they are not, they are not today. They are. I mean, what I want to say is today, they are not going to take Taiwan by force, because I don't think that is what they're trying to do. They probably want to maintain a status quo. What they want is actually, they still want to emphasize on the peace in the region, in the world. What they want to do is actually be a global economic powerhouse, be a global leader in comparison to US. And this is what we have been seeing throughout after Xi has actually secured the third term. You have seen people like the German Chancellor, visiting China to strengthen ties. China is actually going to visit Saudi Arabia to strengthen the Middle East ties. I don't think, all this, they actually are calling for aggressive overtake of Taiwan, creating another catastrophe in the global economy as well. And of course, the focus is in terms of the economic is basically on the high quality growth, right? With technological self-sufficient innovation. That's very important for China in both high quality manufacturing, semiconductor, EV. So they don't want fictitious growth in the financial markets and the real estate. That's why you have been seeing the clampdowns in both tech sectors, some of the financial markets, as well as in the real estate sector. And of course, defending the strict zero COVID policy that protected the country's health and also saved lives. So if you look at it, in terms of the Western lens, we have been seeing, China zero COVID policy has been hurting the economy. Yes, it has been, but it has, another fact is it has been also saving millions of lives. What we have seen during the COVID period in the pandemic is that when US or the developed nations were addressing the COVID policy, millions of lives has been actually lost, unfortunately, in that. So I think in terms of that, China actually take pride in how they have been actually saving the lives, and that's how they have been defending their strict zero COVID policy as well. So I think these are some of the things that we have been seeing on the China's Xi's third term as well. So in a nutshell, in a summary, I think the focus on Xi's third term is basically on the technological innovation, a very strong push for self-sufficient at every level of the technology supply chain. They are carefully managing their political influence and economic strength to be a global, a global power in comparison to US as well. They want to win more friends and allies to counter the tense US and China relation. Very unlikely to use military force against Taiwan in the near term, because that would be counterproductive to winning more friends and allies basically. And of course, China's growth trajectory and technology innovation do face challenges, of course, because US interfering in the semiconductor supply chain. So we really also need to watch China's progress as it strives to be self-reliant. But another one thing that we must not forget is China is a significant trading partner for many of the nations. China is a top exporter, importer for goods globally, fastest growing middle income in the world. And a lot of the Western MNCs and or global corporations actually want a part of this growing consumer market as well. And of course, there's also, we do acknowledge that there's also an upside risk in the China changing of its zero COVID strategy. How China actually basically manage their COVID strategies decision will have to be backed by scientific evidence or WHO declaration saying that COVID is no longer a health threat. And this could possibly be in March 2023, where I think what we call the reopening of 2.0 will be beneficial for ASEAN and Asia countries. So I think that's in summary of the whole China's macro. And maybe what we can do is in next, we can actually look into the structural opportunity, because all these challenges and all, and I've mentioned, all the macro environment, we do see challenges and all ahead, but we also see opportunities, and these are structural opportunities which are beneficial for Chinese economic growth transition as well. So when we look at some of the things like the long-term outlook for China innovation sector is in line basically with the long-term structural opportunities in China. Now there are two parts to the structural opportunity, and how these parts are interconnected to each other is of course is integral in identifying these opportunities. So I think firstly for China to realize its 2035 growth ambition is paramount for China in pursuing towards boosting productivity and innovation. The Chinese economy is currently, like I've mentioned, growth transition where consumption increases as a share of economy. And Chinese policymakers have actually called this strategy dual circulation and put it forward in May 2020. Now, this economic policy plays great importance to tap the potential of its huge domestic market, rely on indigenous innovation to fuel growth, reducing China's dependence on foreign markets while still supported by export growth and expansion into the international market. And of course, with China's middle class expected growth from around currently 400 million to 800 million in 2025, China's potential for rising consumption is substantial, right? So, but however, for consumption to grow, productivity is needed to drive sustained income growth. The government has to rely on technology and scientific discovery to play a key role in solving many of society problems. And the Chinese economy is gradually moving up the value chain by pivoting towards both advanced manufacturing and tech. And of course, the recently outlined China's 14 five-year plan also envisaged the development of the sustainability of growth and the quality of life of its citizens, which contribute towards the 2035 modernization growth. So the technology innovation, green energy, people well-being continue to be the utmost important to the Chinese government, and sectors are poised to benefit from the policy tailwinds. And it is already evident in today. So these includes example sectors like renewable energy, AI, 5G, 6G infrastructure, biotech, and high-end manufacturing, high-end equipment manufacturing as well. So, and with that, when we look into China's innovation, where does it stand today? When we look at the global innovation index, on the left, if you see the economy with 3 or more top 100 science and technology clusters in 2022, I think China is in the second place. The number of total top 100 clusters is actually equivalent to United States as well. So the top 100 science and technology clusters What does it mean? It actually means that the geographical area around the world with the highest density of inventors, innovators, and scientific authors. So you see, in that sense, China is actually on par with the United States. And in terms of the upper middle income economies, in terms of the innovation index, China is basically at the forefront of the innovation ranking, first among the 36 economies. So they are establishing itself as a innovation leader. And when we look at some of the other indicators as well, right? China economies with the most top ranked GII indicators in 2022, China is basically at the third. And if you look at in terms of movement from 2018 to 2022, China has been actually creeping towards the top, from 15 all the way into becoming to now today at top 11. So we can see that they are progressively moving. And when we talk about innovation, something that we cannot ignore is also on the innovation patent files in 2021. So the pink bar is basically the numbers in 2021. The blue one is actually in 2019. And if you look at it, overall, China still outpaced US by quite a bit. And even China alone, from 2021 to 2019, when you look at the numbers, it has the innovation patent filed has actually increased tremendously. So it is actually at the top of the helm. And one thing is that when we want to talk about innovation, some things that we look at is country with most unicorn. Okay, so unicorn here doesn't necessarily means the magical animal or the horse that you actually kind of see in the cartoons and all. But the unicorns here are basically non-listed companies having an enterprise value of over $1 billion. So I think countries with most unicorn, China is not so far off behind US, and basically, US is at about nearly 480 plus, but China is at about 300, and they are closing the gap really fast. And when we look at in terms of the world's top unicorn valuation, we just have to look at the top 5, and basically even top 5, when we look at top 3, the first and the third is Chinese company, ByteDance, TikTok, Shen is fashion retailer. Even Elon Musk SpaceX is actually behind ByteDance as well in terms of valuation. So it shows the natural power of China's innovation in terms of the unicorn and startup sector as well. And nextly, when we look at today's this year, especially this year IPO market, I think China IPO's market has been booming. When we look at it, China, Hong Kong, US, and Europe is actually the top IPO market to actually for a new startup company to list. And even when we compare China's onshore to the Chinese offshore Hong Kong market, I think China IPO activity in China is actually more resilient than in the Hong Kong itself. So you can see that a lot of the innovation, the startups has been coming onto the Chinese IPO market, and that is actually providing, of course, opportunity, new companies, new innovation for us to actually invest in. And even in terms of the China onshore, Asia IPO application, basically ChiNext Market itself has the most has a higher share of active applicants compared to the other traditional and the star market itself. So actually, that means to say, ChiNext Market basically attracts a lot of the innovation and small and emerging companies out there. And another thing that, of course, what we have seen in China itself is one of the structural opportunities we see is basically your energy transition. So you can see that this is the China's evolving energy mix. Basically, you have your solar, nuclear, biomass, wind, hydro, natural gas, oil, and coal. Today, of course, we see China using a lot of the fossil fuel kind of energy, where you see coal is about 52%, oil at 18%. But with China's goal of hitting that carbon neutrality in 2060, I think there is a dire need for China to actually change the energy mix. So if you look at it, by 2060, the amount of solar, nuclear, and wind, biomass, and hydro, they are going to have a significant increase in terms of the energy mix percentage. Oil, coal will be reduce drastically. So in terms of the green economy, the green technology sector, there's also opportunity given that there's a need for energy transition, and it is already in the midst of the energy transition because they need to hit that carbon neutrality by 2060. And when we look at the dominance of the, one of the green economy sector in terms of the solar PV, the solar photovoltaic, in terms of manufacturing capacity by country and region, when we compare 2010 to 2021, you can see that in 2010, China do have some of the market capacity, but it is not at a, high level. But as we go along through the years, you can see that China takes up a lot of the in terms of the percentage shares, in terms of the manufacturing capacity in 2021. When we look at like wafers manufacturing capacity, I think China basically dominate nearly about 90%. When we look at cells, it's more than 80%, and when we look at polysilicon, it's nearly about 80%. So you have seen how Chinese manufacturers are dominating the solar PV sector as well. And when we look at China's dominance in clean energy metal, where clean energy metals are processed, I think China is also taking the dominant in the market itself. Things like copper, nickel, cobalt, rare earth, lithium. You can see that China basically holds quite a large share of the clean energy metal processing. And I think the world demand for lithium is definitely poised or forecast to actually double between 2020 to 2023, as you have seen a lot of global EV uptake rises, that and in all these clean energy, or I mean in all these EV batteries, right, what you need is actually lithium. So, and with China's leading in the race of securing and processing the clean energy metals, much needed for the green revolution economy, I think this could also mean that in the future, new world powers could be minted as demand for clean energy grows. And this is basically what I've been seeing in the clean energy market as well. Another thing, of course, we can't run away is in terms of the EV. There has been explosive EV growth fueling demand for both batteries and cars. And then when you look at it in terms of the China EV and PHEV sales percentage growth, I think China has a tremendous growth compared to other developed nations like Europe and the Northern America. And by battery demand by region as well, you see as the years grow along in the right chart, you see that China has been actually has a tremendous growth as well. So these are where the opportunities in terms of the green technology in the EV vehicle space as well. So that is the second structural opportunity. And of course, third is, I think it's more on the China's healthcare, right? So just now I've mentioned one of the domestic challenge that we see is in terms of the China aging population. I think the demographic advantage that China enjoy for decades, a young workforce that capitulated China to the world's second largest economy, is basically now diminishing. If you look at the left chart, so a shrinking workforce does not augur very well for a country's economy. So is China ready for its rapid growing? What are the economy and social consequences? How to care for hundreds of millions of elderly citizens? And pointedly and tragically, in the coronavirus epidemic, right? There is elderly who are actually suffering. So with that, with the aging population and all, there has been encouragement from the Chinese government, to market and develop innovative series, create profit incentive to provide quality elderly care, cultivate robotic and telecommunication technology for providing partial care. And for China to be China, it must take care of its elderly, right? So for China to become a fully modernized country, I think what it basically matters is its aging population may be its number one economic problem. And with that, it actually reflects in the healthcare expenditure as a share of the GDP. If you can see, every year there has been a progressive growth, and this will continue to grow because of the aging population nature of China itself demographically. And when we look at the healthcare expenditure per capita, I think China is at the far right. It has much more leg room to grow. When you compare to the average OECD company, is at about 4,000 over US dollars, but in China is only 800. So as the growing aging population grow, there's a need for China healthcare, innovation, all this. I think healthcare expenditure per capita will grow in the coming decade as well, and that will bring opportunities. And it is true because healthcare remain one of the driving forces of China's market. So one thing is that China's biopharmaceutical ecosystem is experiencing a momentous shift from a formerly generic focus play into one that nurtures innovation with profound implications for patients as well as industry peers. So innovation in Chinese biopharma is fast becoming a notable story, basically, right? Underscored by the significant value creation on the global capital markets, the market value of publicly listed biopharma innovation players from China across Nasdaq, across Hong Kong Stock Exchange, Shanghai Stock Exchange, Star Market has surged to 3 billion in 2016 to more than 380 billion in 2021. So you can see that China's biopharma ecosystem is actually advancing in the right direction, right? So when we look at the number of Chinese biotech companies, it's actually risen quickly. When we look at in terms of the left chart over here, right, before 1990 to 1990 to 2000, all the way to 2020, you can see the number of new Chinese biotech company has risen tremendously. Of course, in the US also have, but we are starting to see a downtrend when we see from 2010 to 2020. But of course, on the Europe and Japan basically is on a downtrend. Europe and US is almost on a similar pattern. But I think what we will see in the future is basically, in terms of Chinese biotech, there will be more to come. And in terms of the China Asia top 3 sectors, in terms of total fund raise, basically healthcare is one of the top 3, right? So I think this shows that there's a lot of innovation, there's a lot of new companies that's coming up in this sector as well. And the number of clinical trial application in China by company type, if you can see, the China farmers and the biotech has been dominating in China rather than the MNC pharmaceutical company in China. So, and progressively, I think over the next decade or 2 decades or so, this will be the similar trend that we will be seeing. So in a nutshell, I think how ChiNext Index actually provide the mega trend opportunities is that you have your China 2060 carbon neutrality target. Because of the pandemic and growing population, there's increased demand for healthcare related services, and all these for EV, for energy resources and all that, we'll also have to have a increase in the technological self-reliant technology, the demand for semiconductor, the demand for robotics, your AI, cloud computing. So that actually map out how structural developments actually affect China industries in the next 1 to 2 decades. And of course, some of the mega trend exposure in the China index, which I will go through in terms of the EV industry, clean energy. These are some of the names that you kind of see in the index itself. So with that, I think the conclusion is basically the ChiNext Index can ride well on China's high growth development trend in the next 10 years. The index basically encompasses a wide range of innovative growth companies and sectors that may stand in the main direction of the economic development and operation to the right of the materialization of these mega trends in the future. So it is an index that provides an important avenue for implementing the national strategy for independent innovation. So basically, that is my conclusion. And in terms of the investment fundamentals, when we look at performance and valuation, in our analysis, if you use the traditional valuation yardstick, whether on the price book or the price earning ratio, the Chinese market is actually trading at one standard deviation below from the 5-year mean, which is basically at the COVID-19 level. This is for the ChiNext Index itself. When we look at the larger CSI 300 index, it also kind of replicates the same pattern, right? So just to reflect it again. And I think one interesting thing that we have seen is that despite the market volatility this year, I think there are still positive foreign flows into China stocks via the Stock Connect. So there has been positive foreign inflows. The only outflow that we were seeing was in October 2020 and actually in April 2022 of this year. In other months, it was basically positive, and that means to say The foreign investors are basically, understanding the valuation, the cheap valuation of the Chinese markets and the companies, and also understanding the structural opportunities in China for the next 1 to 2 decades. And of course, there's also a diversification benefit. I think a lot of you over here actually probably own some of the, global equities, US equities, or even, equities from a different part of the world, or different other asset classes. And then when we look at it, the ChiNext Index basically have low correlation with major indices and asset class in this diversification matrix, a correlation matrix basically. Yeah, so I think this is definitely an index that you can consider putting in your portfolio to take advantage of the growth transition in China, as well as also providing you with the diversification for your global equity portfolio. So I think some of the notable companies are like the likes of the CATL. Basically, they are industrial leader in battery manufacturing, new energy technology. Now, I won't go through so much on it because I think these are some of the names that you probably known as well. And they are the largest lithium battery manufacturer in the world, controls nearly about 50% of the market share in the sector. Some of the clients are basically Tesla, Mercedes, BM. So if you actually open up all these brands, bonnet, probably inside is probably inside is CATL battery, and that's how they have been dominating the market share as well. And of course, that's under the industrial sector. When we look at in terms of financial, there's also diversification. They have this company called East Money Information. Basically, it's a China-based company that operates an internet financial services platform. They deal in security business. So just to let you know how I mean, for relatable purposes, I think East Money Information is basically like Phillip Securities, like Phillip, where they actually use financial services platform for your investors to trade, do your financial services, your wealth management, and all this. And in 2020, the Daiwa Capital Market estimated that both the stock and mutual fund applications about 22 million monthly active users. So I think it speaks in terms of volume and innovation in terms of the financial sector as well. And of course, another thing is Minray. I think this is a very well-known company, a global medical instrumentation developer. Both Minray products and services are found in healthcare facility worldwide in 190 countries. So it has been widely used in Class A tertiary hospitals in China as well. And of course, when we see you have industrial, you have financial, you have healthcare, and then when we look at consumer staple, you have things like the Yihai Carry Arowana Holding, largest agricultural product and food processing company in China. They actually had an IPO on ChiNext Board on 15 October 20, and they contribute nearly 60% to Wilmer's annual turnover. Wilmer is their parent company, and 40% net profit. So what I want to kind of highlight is that you can see the different diversification across each of the sectors in terms of the companies, and each of the company actually are market leaders in their respective sectors as well. And of course, why UOBAM Ping An ChiNext ETF? Today, the ETF itself aims to track the ChiNext Index by, of course, investing all of the fund assets into the Ping An ChiNext ETF. Basically, we are launching this ETF under the MOU between Singapore Exchange and Shenzhen Stock Exchange. Now, this ETF itself provides a unique opportunity for our domestic investors in Singapore to reap the rewards of investing into futures of China innovation. And it's very interesting today. When you look at the name, there's a Ping An name to it. So let me just go through why. Because UOBAM has a joint venture with Ping An Fund Management in 2011. When we expanded into China to capitalize on China's long-term economic and financial market growth potential, Ping An, as of 31st August, has an AUM of nearly about 800 million under their asset management arm. And this setup is also, UOB's AM competitive advantage because we are able to fully leverage on the onshore domestic investment capabilities and local expertise via a mainland Chinese reputable fund manager to offer investors outside China a direct access to the country's onshore investment opportunity. Because I think if you compare to some of the asset houses or ETF houses, a lot of them, when they manage China onshore equity, they actually manage it offshore, which is via Hong Kong. But today we have, Ping An, a very reputable name, right on China onshore itself to actually manage the investments. And this is China's, Ping An's onshore capability. They have an equity research team under different of the sectors, big consumption, AI, manufacturing, macro cycle. So they have very strong teams of analysts, investment managers, and research personnel to actually manage and research the investments. So I think in a nutshell, what we are trying to offer you is the simplicity and accessibility, because the ChiNext market itself is very much less accessible to the foreign retail investors. Basically, it's only mostly for the foreign institutional investors and they are local retail investors. And of course, no tradable on XGX from 1 unit per order. And of course, you can use your cash or SRS. And another thing is that it's actually EIP product. Basically, EIP product is a retail-friendly product that does not require a fulfillment of CAR criteria to trade. So there's a simplicity in this. Simplicity and accessibility is the key in terms of why you'll be Ping An ChiNext ETF. And of course, this ETF allows you to participate in China's growth transition and the structural opportunities. These are the key characteristics of the ETF itself. So yeah, I think you can also trade through Phillip Nova. And with that, it comes to the end of my presentation. Yep. Thank you.
Yeah, Edward, would you be able to take a few questions? We have one from the member of the audience, but before we jump to that, would you be able to walk us through the key takeaways, the 3 key takeaways for today's session? What do you want us to remember about the ChiNext Index?
Yeah, sure. So I think the key takeaways very simple. Today, one thing is I've just mentioned, right? This ETF itself, we are giving you the accessibility to the China onshore equity market, because the China onshore equity market, basically the ChiNext market or China Index, is not really accessible to the foreign retail investors. There's a limitation to it. Today, we're giving you the opportunity to trade via XGX itself. You have your Sing dollar to kind of trade it easy, and then you can actually write. And of course, the second point is basically write on the China growth transition structural opportunity that is presented in the growth transition in terms of the mega trend opportunities. Yeah, and also the correlation matrix that I've shown you is a diversification and also a complementary to your global equity portfolio. Yeah. I think these are the 3 key takeaways that I probably want to actually kind of highlight to your investors out there today.
All right, members of the audience, if you have questions, you can type them in the question box. It's somewhere at the bottom of your control panel. Just head in there and type your questions, and we'll pick them up for Edward to address. Next is a question from JC. Very interesting question. He's asking, what are your opinions about the economy shrinking gradually due to the population? Will the country grow old before becoming wealthy?
Yeah, I think that's a great question, right? So, like I've mentioned, what they're trying to solve is, they don't want the China's demographic to grow before becoming rich, and that provides a lot of other challenges in terms of the middle income trap and so on and so forth. So in order for that to be solved, what you need is basically productivity, because when you have a growing population, one thing is that you have lesser people joining the labor force. And how do you want to increase the productivity when you have lesser people in the labor force? Basically, what we need is technology. You need your your productivity increase. That's where your technology come in. That's why China is emphasizing a lot in terms of how they need to be technologically sufficient. They need to use AI in terms of even in the healthcare sectors, because probably with lesser people in the labor force, you will have lesser doctors, you have lesser nurses. And how do you provide care? One way is through, of course, in terms of technological advancement in the healthcare sectors, in terms of the medical advancement, in terms of drugs, in terms of equipment and all this, to actually help in aiding the growing population. Yeah, so I think that is naturally what is also trying to achieve. And of course, China has other policy. Of course, they scrape away the one child policy and so on and so forth. But growing, increasing a population size, or asking your citizen to have more kids and all this is not a very straightforward kind of a solution you can do. Even in Singapore, we see that no matter how much you try to give incentive for having babies and all this, it is not something that actually moves, because I think as the population become educated and all this, I think the aspiration changes as well. So there's a lot of social demographic changes, but with that, how do you change, and with these changes, how do you actually kind of handle the productivity issues, basically through the use of technology. Yeah, that's why I think in Singapore itself, when we take a look into the comparison, we are moving into a digital economy space, where in China it is the same thing, but in China it is more of a pressing issue, because the sheer amount of population you have is relatively large, and that creates a lot more social economic problems.
All right, next question from David. He's asking, is there liquidity for this ETF? Is it liquid? Does UOB buy back from retailer investors?
Oh, we do have market makers, and basically this the ETF itself actually invests, or like I mentioned, actually there's a master ETF called the Ping An ChiNext ETF itself. The Ping An ChiNext ETF has an AUM of about 300 million in Chinese yuan itself. So there is fairly liquid, and in terms of the index itself, I've shown you in terms of the index trading volume is on par with the Hang Seng Index itself. So I think in terms of the liquidity there is, and the only way for you to actually assess in a straight through process in terms of investing to ChiNext Index or the ETF itself is through our ETF, where we actually invest into Ping An. Yeah.
I think the next question that we have, and the last question for the day, since we are running out of time, is a very interesting one, Edward. I think this is something that's very much in our investors' minds right now. Is now a good time to enter the Chinese market? Are we touching the bottom yet? Because many of our analysts that we religiously listen to are hinting at a possible recession in the next year. What are your thoughts on this?
Okay, I think in terms of our thoughts is that one thing is, when you look at the performance and valuation, as I've shown you, right, is trading at a one, in terms of price book ratio, price earnings, actually trading at a 1 standard deviation below the 5-year mean. That means to say it's actually at the COVID-19 level. So when you look at in terms of that, the valuations are really attractive, cheap valuation. When do you have a chance of such a gain? And when we look at it, China today, when we look at the COVID policy, it is kind of pivoting to easing and restriction, and that could actually encourage reopening, and we will probably see a more certain in 2023. We see a lot of the other US banks actually moving on to overweighting China and all. In the recent news, you probably have read it as well, and this is also a view that we actually share as well, because can you imagine with China opening up, with the ease of traveling and all this kind of thing, there will be a huge tourism boosting in Asia, equities, as well as also in terms of the Chinese equity itself. So I think there's a lot more a lot more opportunities in front rather than all the negative headlines. So this is something that we do see, and I think this is a good time to actually kind of look into the Chinese market, have your diversification, or if not, add into your portfolio. Because if not, you probably, once the market run, you'll be just chasing the market, right? And if you look at it, the market has been the Chinese market has been actually rebounding quite a bit as well. So I think don't chase the market, be a early investors, so that you can actually be buying at a lower point, and then from there, when the market runs, you are already in the money. Yeah.
All right, that's all the time that we have for. Thank you so much for your insights, Edward.
Thank
Members
you.
of the audience, if you have questions for Edward and I mean post webinar, please feel free to type them in the survey form at the end of the webinar, and we'll direct them to Edward to address in our follow-up email. Okay, this session is recorded, so you can catch up on the insights shared by Edward through a video link in our follow-up email tomorrow. Yes, and that's all the time we have for you today. Stay safe, take care, and till the next session that we have Edward on board. See you then.
Thank you, Sri. Thank you, everyone. Bye bye.
Right, goodbye.